ex-NCOS, Mr. Shegun, my co-speaker, Barrister Adesuwa Monua, participants at this program, good afternoon. It's a privilege to be with you today. I'd like to speak, as I've been asked, on capital allowance. I think I'll be speaking basically on the basics. It's not a computational workshop. We just want to share ideas and remind us of some things that we already know, and I believe we'll also learn from it. Let me first start by defining capital allowance. Capital allowance is a relief that is granted to a taxpayer who incur qualifying capital expenditure during a basis period in respect of assets used for purpose of a trade or business at the end of a basis period. So that explanation, we need some that definition, we need some explanation. Firstly, depreciation is, capital allowance is in lieu of depreciation. Tax authorities actually want an equitable way, a just way of allocating qualifying capital expenditure. Therefore, instead of granting depreciation, they disallow depreciation and instead grant capital allowances to the taxpayer who has incurred capital expenditure that qualifies for capital allowance. Secondly, for that definition brings for the fact that the asset must be in use at the end of the basis period. The basis period is the accounting year of the firm. And of course, the basis period must be defined, right? Then the qualifying capital expenditure incurred must be with respect to a trade or business. So if the qualifying capital expenditure is being used for other things other than trade or business, then it will not qualify for capital, or the tax authority will have to share in a pro rata way the parts used privately and the parts used for the business. And then we said for you to have capital allowance, of course, you must apply for it also. You must apply to tax authority for the capital. You must submit the qualifying capital expenditure to the tax authorities. Having said that, we need to look at some definitions. Like qualifying capital expenditure is the amount spent for acquisition of assets that increase the earning capacity of business, for which capital allowances are claimable. Then remember that capital allowances are granted on preceding year basis. In other words, if the tax year or year of assessment is 2020, the relevant accounting year will be 2019 year. Okay? Then of course, capital allowance is in lieu of depreciation, as we have mentioned. Then capital allowance is claimable only on assets when the asset is being used for trade or business. By way of emphasis, third thing I'd like to look at is the certificate of acceptance, also known as certificate of acceptance of fixed asset, CAFA, CAFA. It must be obtained from the Industrial Inspectorate Department or Division of the Federal Ministry of Industry, Trade and Investment before capital allowances can be granted for qualifying capital expenditure more than 500,000. However, in practice, there's a time lag between the claim for capital allowance and the issuance of that certificate. There's definitely going to be delay. and bottlenecks in getting the certificate. There are some issues arising with this certificate of acceptance. Firstly, more recently, the division had issued letters to taxpayers to come and obtain certificate for qualifying capital expenditures that are over 500,000. And I think this is the division or directorate does it from time to time. The department does it from time to time when it feels that people are becoming slack about getting this certificate. But more recently, the Federal Inland Revenue Service has picked it up, and on May 22nd, I guess, May 9th, 2022, they have issued a public notice that any taxpayer that does not get the CAFA for basis year 2016, for tax year 2016 to 2020, such a person who had enjoyed capital allowances based on former traditions, the capital allowances may be withdrawn. And this is what has actually provoked this workshop. Given this public notice, we need to examine some issues relating to this notice. The first thing is that there's agitation that this certificate of acceptance or the obtaining of certificate of acceptance is at conflict with CETA, which is the regulation that guides assessment of tax as far as companies are concerned. The conflict basically is that CETA does not specify any way by which you can claim your capital allowance. No inspection or anything of assets, as long as you can provide your receipts or evidences otherwise that you have acquired a qualifying capital expenditure, you can be granted the capital allowance. Then secondly, CAFA is not statutorily required for you to claim capital allowances. I've said that again. Then thirdly, the cost of compliance is unreasonable. By that I mean, look, if you look at the exchange rate, the time these laws are made for 500,000 as the benchmark or the threshold for which you can obtain capital allowance, if you look at the exchange rate now, how much is 500,000? It means that small assets will be involved in obtaining this CAFA. When this regulation was made, it was for massive assets. So by now, it will be too cumbersome for a company, for every asset that you acquire, you want to come and get, you need to go and get a CAFA. Then of course we said, since the deadline is too close, October 31st, 2022, the tendency is that people want to beat the tax law, corruption, either from the regulator or from the taxpayer, just to comply. Then of course we have said that the moment tax becomes complex, non-compliance increases. And then finally, we said the cost of processing the CAFA is not reasonable. Okay? Then again, we are going to look at what we mean by qualifying capital expenditure. The capital expenditure incurred for the purpose of generating income and qualifies the company to enjoy capital allowances is what we call qualifying capital expenditure, QCE. There are 9 items here in CETA for which a company may enjoy capital allowances. We are building, of course we are building there as the number 1. Okay. Sorry, let me enlarge my You are building. The next one we have plant, expenditure on building, expenditure on plant, expenditure on public transportation, vehicles. So vehicles used for public transportation. You have agricultural expenditure, plantation expenditure, public transportation, new mass transit coaches of 25-seater and above, mining expenditure, research and development expenditure, expenditure on development of software or other digital outlay on electronic application. The next thing I want to look at are types of capital allowances. You have initial allowance, annual allowance, and investment allowance. The initial allowance is granted once in the year of acquisition of the asset. It doesn't matter when the asset was acquired within the year. There's no prorating. Even if you use the asset for only 1 year, you get it once and for all. And then of course we have annual allowance, which is granted annually. And to arrive at the annual allowance, we'll deduct the initial allowance from the cost and divide by the useful life of the assets. And that will go on yearly. It's on a straight line basis, so every year you get equal amounts after your initial allowance. There are percentages for annual allowance and initial allowances depending on the kind of qualifying capital expenditure. Of course, the last type of capital allowance is the investment allowance. We have reconstruction investment allowance and rural investment allowance. The reconstruction investment allowance is in section 20, subsection 1 and section 32, subsection 1 and 2 of your CETA, and the rural investment allowance is in section 34, subsection 1 and 2. For the reconstruction investment allowance is 10% on plant and equipment, 10% on plant and equipment. And then of course for the rural allowance, it depends on the facility infrastructure that's not available. Where you don't have light, you don't have water, you don't have road, the taxpayer is entitled to 100% on the qualifying capital expenditure. But where you don't have electricity alone, you are entitled to 50%. And of course, where there are no roads, you are entitled to 15%. There used to be a percentage where there is no telephone, but that has been abolished since 2011, since we now have GSM everywhere. There are other tax incentives granted by the tax law. 20% investment credit is granted for research and development, qualifying capital expenditure on commercial basis, commercial scale, sorry. Then 25% tax credit is granted to companies engaged in fabrication of tools, spare parts, and simple machinery for local consumption and export. This is to encourage technology. Then 15% tax credit is on qualifying capital expenditure is granted to taxpayers who purchase locally made plant and machinery. Of course, it's clear the reason why this is done is to encourage local manufacture of plant and machinery and our technology. 100% capital allowance is granted to a company that incur qualifying capital expenditure on building, plant and machinery in an approved manufacturing activity in an export processing zone. In this case, there will be no investment allowance granted. 95% capital allowance is granted in the first year to a company that has incurred qualifying capital expenditure on purchase of plant and machinery for purpose of replacing old ones, with the remaining 5% retained in the books until disposal of the asset. These are some of the other tax incentives that government is giving. Of course, the 17 I look at there is capital allowance rates. There's no need to memorize them, they are all there. The rates for building, for initial allowance and for annual allowance. For example, for building, qualifying capital expenditure on building, initial allowance is 15% and annual allowance is 10%. In other words, if you bought a building for 100,000 naira, your initial allowance will be 15% of 100,000. That will give you 15,000. Okay, if you remove that 15,000 from, you remove the 15,000 from 100,000, you get 85,000. You divide that by the useful life of the assets, and you get your annual allowance. Annual allowance is basically on a straight line basis. Okay, that's found in our table here. The list are here. Of course, the capital allowance rate for Peter, personal income tax, is also displayed in table 2. Thank you for listening.
Thank you very much, sir. That was Professor A.S. and Leslie Dabo, BSc, MSc, PhD in Accounting, ACA, Dean, Faculty of Management Sciences, University of Benin, and he took us on the topic capital allowance. We thank you very much, sir, for that enlightening lecture. Thank you, sir. So we call on our next speaker. We call on our next speaker, Barrister Adesuwa Omonuwa, an Oxford-trained Nigerian legal practitioner. She's taking us on the topic, legality of certificate of acceptance. A round of applause for her, please.
Good afternoon. I will be speaking on the legality of the certificate of acceptance. And in this brief presentation, I'm going to be looking at 5 basic questions. 1, what is the certificate of acceptance? 2, what is the legal framework behind the certificate of acceptance? 3, deadline for submission of certificate of acceptance. And 4, what is or what are the consequences of failure to comply? And 5, subsequent requirements, any subsequent requirements. 1, what is the certificate of acceptance? This is a new requirement, I'd like to say, recently announced by the FRIS, the Federal Inland Revenue Service. New in the sense that they are now requiring, it may have been existing on the books, but they are now requiring that the taxpayer submit to them a certificate of acceptance, or CA, issued by the Inspectorate Division of the Federal Ministry of Industries, Trade and Investment. And this is for individuals or corporate taxpayers that have incurred within the basis assessment period a QCE, that's qualifying, a QCE of a minimum of 500,000 naira. That QCE is the qualifying capital expenditure. That would entitle them or mandate them to obtain a certificate of acceptance that will be used by the FRIS in accessing the tax liability for that period. What is the legal framework behind it? This arises from Section 3 of the Industries Inspectorate Act, which forms Cap 18 of the laws of the Federation of Nigeria, Cap 2004, as amended. The laws of the Federation of Nigeria is the compendium of all the acts compiled under the laws of Federation of Nigeria. So this Industrial Inspectorate Act has been there, but recently the FRIS is now saying that pursuant to that Section 3, the certificate of acceptance needs to be obtained from the Industrial Inspectorate Division of the Federal Ministry of Industries and Trade, for any qualifying capital expenditure, qualifying capital expenditure QCE of at least 500,000 naira, and then submitted to the FRIS. And there is a deadline for submitting that, which we will be looking at. But in a minute, let's quickly look at the qualifying capital expenditure. This is expenditure incurred in a defined basis period and is assessed as capital allowance as basis for reduction of tax to companies when estimating their tax profits. In other words, if it's not there, if the capital allowance is not there, the tax will be very high. So paragraph 1, subparagraph 1 of the second schedule to the CETA, the Companies Income Tax Act, specifies certain different forms of capital that may fall under the qualifying expenditure capital allowance category. And these include expenditure deployed for plants. For instance, we buy generators, machinery or fixtures, construction of buildings, structures or works of a permanent structure, such as things that can expand your business, or incurred in connection with or preparation for the working of a mine, oil well, or other mineral deposits of a wasting nature, or capital expenditure incurred on the development or acquisition of software for your business, such as maybe computers and other things. So the Industrial Inspectorate Division is empowered by that Inspectorate Act to assess and investigate any proposed new or existing undertaking involved in any capital expenditure, such as the ones I listed, for the purpose of determining the investment valuation of the undertaking. Investigation by the Industrial Inspectorate Division usually covers determination of the actual capital, the cost, whether it's in foreign or local currency, utilized in purchasing it, and then the actual value of the building, if you are talking of a building, or a plant, generating plant, if you are talking of a generating plant, or other machinery, such as we listed, the actual cost of those machinery, and then the the currency involved, whether it be foreign exchange or local currency. And then this certificate of acceptance is issued by the Director of the Industrial Inspectorate Division of the Federal Ministry of Trade to companies showing that investment valuation or expenditure made by the companies in connection with the allowable capital allowance recognized under CETA. In other words, it has to be a qualifying allowance. That's why it's called qualifying capital expenditure. It's not just any type of expenditure. It's the ones that fall into that category. The certificate of acceptance is to be considered by FRIS as definitive evidence. It doesn't require any further proof. Whatever is on the certificate of acceptance is accepted by FRIS as conclusive evidence of what you are entitled to in terms of capital allowance. Under Nigerian tax laws, there are several capital allowances which are recognized in this area. That is in lieu of deductions, that is allowances and deductions to be taken into consideration when assessing tax liability for a particular period. One of these is qualifying capital expenditure expended by a company in activities like building of structures, mining, and even other technological things like, maybe computer hardware and so on are necessary for your business. When a company relies on these acquisition of assets as part of its processes for generating profits, the law allows that company to deduct the cost of acquiring those things from its tax. And that is what is the capital allowance. As long as it obtains a qualifying certificate or a certificate of acceptance covering them where the cost of those things are at least 500,000 naira. So this requirement, when it is submitted to the FRIS, enables the FRIS to, it facilitates his work. He does not need to carry out another independent evaluation. He accepts the information on it as is, and it uses it, in carrying out his own assessment. So it enlightens self-interest for the individual taxpayer or company to obtain this certificate of acceptance, and it also makes the work of the FRIS easier. However, there are one or two issues which arise, from this new emphasis on it. I say new emphasis because it has always been there, but it's a new emphasis. And because it has a deadline, the deadline is just about a month away, October 31st. Now, can they meet that requirement? Can companies, meet the submission requirement? And what I have proposed here is that, one, it will be necessary for the process to be seamless and timely. The process of acquiring or obtaining that certificate of acceptance to be made as easy and uncomplicated as possible, so that it will be done as timely as possible. And secondly, they may consider the time being extended. That deadline, as we said, is 31st of October. Now, what are the consequences for failure to comply? The major consequence from failure to comply is that those capital allowances that any given company has enjoyed up till date, upon failure to comply, the FRIS can withdraw those allowances. And the obvious consequence of that is that the taxation or the tax liability will necessarily increase. And of course, that will affect the business. So to avoid those complications, it's better to comply. And to facilitate compliance, then those issues are raised, the time could be extended, and then the process could be made simpler. The bureaucracy involved could be made simpler. Then any subsequent requirements, well, under the new directive, in the initial process, the one that is the compliance that has to be effected by 31st of October, the basis period is 2016 to 2021, 5 years. However, after that basis period of 2021, the tax for 2022, which doesn't come up yet because we are still in 2022, would require a separate certificate of acceptance for QCE that is 500,000 and above. So in other words, every subsequent year in which there is a QCE of 500,000 and above would require a certificate of acceptance. In other words, it's going to be a continuous requirement. And that in a nutshell is a summary of the legal framework establishing the legality of the certificate of acceptance. Thank you.
Thank you very much, ma'am. That was Barrister Adesuwa Omonuwa, an Oxford-trained Nigerian legal practitioner, who took us on the topic, legality of certificate of acceptance. We thank you so much, ma'am, for that enlightening lecture. So we call on our final speaker, the person of Mr. Segun Orimogunje, the CEO of Exploits and Colors International. Please welcome him.
Thank you very much. Good afternoon, ladies and gentlemen. I thank you all for being here. Wonderful Oxford-trained Nigerian lawyer, barrister Adisu Obondua. Thank you very much. I thank Professor Dabo for being here. I thank everyone here, the crew, everyone that has been listening to us and has participated actively. We go on to talk about the collection of the certificate of acceptance. The process involved, it's not very difficult to follow. It's just a matter of determination to obtain it. So the outline, we're talking about what certificate of acceptance is all about, then the forms that will be completed. We're talking about the procedure. We talk about the procedure for collection of certificate of acceptance. Important notes about the certificate of acceptance. Certificate of acceptance of fixed assets, usually called CAFA, in this context is the certificate issued by the Industrial Inspectorate Department of the Federal Ministry of Industry, Trade and Investment to evidence or certify the true value of capital expenditure in the capital undertaken by a business organization in Nigeria. Capital undertaking, when we talk about capital undertaking, we're talking about an undertaking carried out by way of trade or business for the production of goods and services or for sale and receiving of industrial machinery and other equipment, plants, buildings, and other permanent or temporary fixtures on land. We're talking about activities, business transactions carried out for the sake of production. For the sake of production. So when we're talking about certificate of acceptance, we're talking of certificate issued on capital expenditure of assets, expenditure on fixed assets, not current assets that are used in production process. We have Form NICE. Form NICE is called NICE because of the meaning. It is notification of intention to incur capital expenditure. It is Form 1 issued by the Federal Ministry of Industry, Trade and Investment, the Industrial Inspectorate Department. The Industrial Inspectorate Department of the Federal Ministry of Industry, Trade and Investment issues this form at the beginning of the business period of an organization. So at the beginning of your business period as an organization, you approach the Industrial Inspectorate Department of Federal Ministry of Industry, Trade and Investment so that you would be issued Form NICE, and then this Form NICE will complete and submit at the beginning of your business period. It helps you because if your pricing is not okay, they could advise you from the ministry that this pricing, we have this value, this asset at this value could be got from this point at this rate. Rather than spending this much on it, you can get a very good quality out of it at this amount. So it has its advantages. It's not all about stress and disadvantages. We have the return summary. The return summary it provides a summary of the new or additional capital expenditure made in the period. It provides a summary of various categories of the assets together. They are the categories of assets that are separate, that have been separately reported on the PCF's project completion forms will be aggregated on the return summary. The categories of the capital expenditure on the return summary are building and site development, machinery and equipment, then miscellaneous assets and motor vehicles. They are all aggregated for the period. Then we have the project completion forms. The project completion forms give the information to return summary. The information for the return summary are obtained from the project completion forms. The project completion forms are for various categories of capital expenditures on building and site development. You have for imported plant, machinery, and equipment. You have for locally purchased plant, machinery, and equipment. You have details of imported miscellaneous assets. You have details of locally purchased miscellaneous assets. You have details of locally purchased motor vehicles, and you have details of imported motor vehicles. To obtain your certificate of acceptance, the business organization obtains, completes, and submits the Form 1 at the beginning of the period, like we said. Even if it has not been completed at the beginning of the period, at the end of the period, the officials at the department, they are quite accommodating. They still allow you to fill and submit with the other forms that are supposed to be submitted at the end of the period. So the business organization obtains, completes, and submits the following with a covering letter at the end of the period. You submit Form 1 where it wasn't submitted at the beginning of the business period. Then you submit your return summary. You submit your project completion forms for the various categories. You submit your supporting documents as specified on the project completion forms. Each project completion form has documents that you attach to that category. Then you have the endorsed audited financial report. The covering letter is addressed to the Industrial Inspectorate Department of Federal Ministry of Industry, Trade and Investment. The ministry reviews and contacts the business organization or the consultant, where the business organization has expressly introduced a consultant as its representative. If there's any need for a review, the ministry will inform the company. Otherwise, the ministry schedules an inspection of the assets at the sites of the assets with the representatives of the organization at the convenience of the representatives and the ministry representatives, the organization's representatives and the ministry representatives. The ministry representatives will send the inspection report to the ministry's headquarters in Abuja. Then the certificate of acceptance is issued from the headquarters in Abuja. There are notes that are important. One, plant, machinery, and equipment are directly involved in production process. Assets that are classified as plant, machinery, and equipment in one organization may not fall into that category in another organization, because the organization that is, for instance, into transport would have their vehicles as plant, machinery, and equipment, while for an organization that is into hotels, for instance, may not have that as part of their direct production process. So it will not be recorded as plant, machinery, and equipment. So what this means is, for an asset to be classified as plant, machinery, and equipment or miscellaneous asset is dependent on its involvement in the production process. Miscellaneous assets are assets that are not directly involved in the production process. An asset that is recorded as plant, machinery, and equipment for an entity may be a miscellaneous asset for another entity. Once a business organization has collected a certificate of acceptance for a year, it cannot be issued for a previous year again, but for subsequent years. If, for instance, you have collected a certificate of acceptance for year 2021, you cannot go back to the ministry to ask for certificate of acceptance for your qualifying capital expenditure in 2020. You can only ask for 2022 and on like that. If your business is going to consider capital allowances for previously acquired assets, then they have to collect certificate of acceptance for all those years to make it easy for them to apply for capital allowances on the assets if they are still in their productive life use. A business organization is responsible for the logistics of the inspection. So let business organizations take note of that. The submission of certificate of acceptance for 2016 to 2021 will be due by October 2021, by October 31st, 2022, this year, next month, according to the instruction from FIRS. The instruction came around May this year, and now October is just a month away. October ending is just a month away. Submission of certificate of acceptance, that means it must have been obtained from the Federal Ministry of Industry, Trade and Investment and must have been submitted at the Federal Inland Revenue Service before the 31st of October 2022. Any business organization that enjoyed capital allowances from 2016 to 2021 without submitting required certificate of acceptance will lose the capital allowances enjoyed and will have to pay backlog of taxes due. And I'm sure you can imagine the huge implication that will have on their financial performance for this year. This will be very huge on some organizations. It could actually be strong on some organizations. Henceforth, every business organization is mandated to submit certificate of acceptance for qualifying capital expenditure to enjoy capital allowances on such expenditures every basis period henceforth. So for year 2022, for instance, the certificate of acceptance for qualifying capital expenditure for this year 2022 must be obtained and submitted before the end of year 2022, that's before the end of December. Must be submitted to FIRS so that they could claim capital allowances on those capital expenditures for 2022. Likewise for 2023 henceforth, every year end certificate of acceptance must be obtained and submitted to Federal Inland Revenue Service by business organizations. Business organizations that have not enjoyed capital allowances on their qualifying capital expenditure in the past are encouraged to enjoy the tax reliefs provided through capital allowances henceforth. Like Professor Dabo told us, your assets could even be what will earn you tax reliefs that could improve your profitability in a basis period. If you do not file these assets for certificate of acceptance, you may not enjoy capital allowances on them and you may be losing a lot, despite the fact that those assets have been acquired by you and they are being used and they are depreciating in your records. It's necessary to encourage all business organizations to enjoy capital allowances on their assets. It is advisable to engage a consultant who is already familiar with the process for the obtainment of the certificate of acceptance if the organization may not have the competency to do it. If you do not have the competency to seek for the certificate of acceptance, you could come to a consultant who is familiar with it to help you out rather than lose these valuable reliefs. So at this point, Experts and Colors International, we are here to assist all our clients. Thank you very much. The previous one was